Hi there, welcome to the Equity Trust Virtual Training Center. My name is John Bowens. In this short segment, we're going to cover a question that is on the minds of so many investors across the country, and that is, are we facing a retirement savings or retirement plan crisis in the United States? And factually, statistically, many would argue that we are, and we'll provide some of those data points in just a moment. Now, the follow-up question to this is, what can we do about it as investors? How do we take action? How do we hedge against inflation? How do we hedge against stock market volatility? How do we hedge against potential rising tax rates? And one of the ways that we can do that is by taking control of our retirement savings, taking control of our retirement plans, and self-directing. So we'll talk about that. Now, some data points. The Government Accountability Office study that was performed in 2015 reported that 50% of Americans have very little or $0 in an IRA, 401k, or other equivalent retirement account. 41% report $0 in an IRA, 401k, or other retirement plan. And of the 50% that have capital in an IRA, 401k, or retirement plan, a majority don't have enough money to sustain their long-term health care and fixed income expenses. So in other words, Americans just don't have enough money saved in IRAs, 401ks, and other retirement plans. Now, a quick history lesson. Prior to 1974, many Americans had access to what are referred to as defined benefit plans, pension plans. So you worked for a corporation, and this goes back to the Revolutionary War days, where Americans had access to pensions. So you work over your lifetime, and then when you retire, based on your years of service and how much money you made, you received a fixed amount every single year, no matter what happened. Now, that was very beneficial to Americans, but what happened in 1974, which had actually started in the mid-60s, Congress created the Employee Retirement Income Securities Act, and that was in 1974. And that gave birth to IRAs and 401ks and all of the types of retirement plans that we see today. That 1974 Act was the stimulus for corporations to migrate away from pensions into what are known as defined contribution plans, also known as 401ks, 403bs, thrift savings plans. So this is where you as an employee, the burden is more on you to make contributions. Now, this is all contingent on an individual making contributions and really being diligent about maxing out those contributions on an annual basis. You'll learn that with 401ks, 403bs, 457s, thrift savings plans, you could potentially contribute over $20,000 a year, depending on whether you're under the age of 50 or over the age of 50. You can sometimes contribute less or more. With IRAs, you can contribute up to $6,000 in tax year 2022, $7,000 when you're of the age of 50 or over. So you're limited in terms of how much money you can contribute to one of these plans on an annual basis. And unfortunately, we find that Americans are just not contributing enough to their retirement plans on an annual basis. Because remember, it's all contingent on the taxpayer to make that decision, the American to make that decision to put money into their retirement plan. And unfortunately, society, if you will, has conditioned people, and I've seen it over the last 15 years, I have seen investors raid their IRAs. During the pandemic, there was the coronavirus-related distribution that was under the CARES Act, and that allowed people to take distributions from their IRAs and 401ks and other retirement plans up to $100,000 and not pay taxes or penalties, assuming that they put the money back into the plan within a certain period of time. Well, how many people do you think are defaulting on that obligation? I don't have that statistic just yet, but I can venture to argue, and if I bet, I think that I would win that bet, that there's going to be a vast number of individuals that never return that money to an IRA. Now, why is that a bad thing? IRAs, Roth IRAs, SEP IRAs, 401ks, they carry some very unique advantages from a tax planning perspective, as well as from an estate planning perspective. So number one, an IRA or 401k or Roth IRA, it grows tax-free or tax-deferred. Tax-deferred if it's a tax-deferred traditional IRA, for example. And then if you have a Roth IRA, which is funded with after-tax dollars, it grows tax-free. When you take the money out, you pay 0% tax. So Roth IRA can make a major impact over the long term. And Americans, unfortunately, are conditioned to, when times get tough, to raid their IRAs. In fact, I saw a lot of people in the pandemic, they didn't absolutely need to take money from their IRA, but when they heard that, oh, tax and penalty-free withdrawal, I'm going to go ahead and start dipping into my IRA, they did that. In fact, there's even laws that allow you to, under the tax code provisions, to distribute money from your IRA under hardship withdrawals, first-time home buyer. There's all types of provisions or exemptions. And unfortunately, those exemptions create loopholes, and investors or individuals take advantage of those, and they're using them for the wrong reasons. So number one, the IRA is a highly tax privileged account. You can grow wealth tax deferred or tax free. For example, I have a husband and wife couple who took a $200,000 Roth IRA. Actually, between the two of them, they both had Roth IRAs, combined $200,000. And through property investing, real estate investing, they've grown those Roth IRAs to over $1 million in properties and $130,000 in annual cash flow. And they plan on leaving those Roth IRAs to their grandchildren or children, and they'll be able to benefit tax-free. So Roth IRAs in general, avoid probate. And you can take advantage of leaving a legacy to your children or grandchildren. So it's important to understand those tax advantages and that the IRA avoids probate. Also, there can be creditor protection. A lot of people don't think about the fact that your IRA has all of these unique tax advantages, probate protection, and potential creditor protection. So why would we want to take that money out and expose those dollars to taxes, expose those dollars to creditors, and expose those dollars to potential taxes upon death? We want to keep the money in the IRA. Unfortunately, we have a society problem that has conditioned people to, when things get tough, even just a minor challenging situation, first thing people think is, how do I dip into my IRA? We want to think about our IRA as a high performance vehicle, not a lifeboat. So let me give you a couple data points here. As I mentioned before, this retirement plan crisis. So according to the Government Accountability Office study that was performed in 2015, 50% of households have little to no money in a retirement plan. 41% of households had $0 in a retirement plan. The study went on to say that individuals between the ages of 55 and 64 have an average retirement account balance of $104,000. That's it, $104,000. Between 65 and 74, $148,000. So is $150,000 roughly enough money for a 74-year-old to last their retirement years? Many would argue that is not. So they're going to need to come up with other sources or other programs to be able to sustain their long-term life. We then talk about Social Security. According to the Social Security Office of Policy, the Social Security Fund will be insolvent by 2038. So unless there's major reform, there's not going to be enough money in the coffers, which means most likely people will either be getting less, or they will have to extend the date at which they start taking distributions or will receive withdrawals from that particular account. So we have a major challenge in this country. And how do we address this? Well, number one is taking control and maximizing contributions on an annual basis. The average contribution to an IRA is only about half of what Americans can contribute to retirement plans. And again, we have thousands of people that are raiding their IRAs on an annual basis, in some cases paying significant taxes and penalties in order to get access to their IRA. We do a lot of work in education around real estate investing with retirement plans. You can use a self-directed IRA or 401k or Roth IRA to buy real estate. And I've had people that have actually taken all their money out of their retirement plan, paid taxes and penalties. In some cases, over 50% of their retirement plan was lost to taxes and penalties. And then they use that money to go out and invest in real estate. Well, you don't have to do that. You can use your IRA and self-direct it and begin investing in real estate or private money loans or gold and silver or private equity investments. You don't have to take that money out and expose it again to taxes and creditors and ultimately have less dollars to be able to invest with. So let's talk for a moment about tax advantages. Let's just do a quick compounding interest example. So if I start with $1 today, and let's say I make a contribution of $6,000 per year, and let's assume that we're going to make, let's just say a 10% return per year. And we're going to start at the age of 35 and conclude at 65. So we're going to say 30 years. Every year we put $6,000 in. I chose 6,000 because that's the maximum contribution to an IRA for someone under the age of 50 in tax year 2022. Now that might go up in future years. And yes, 401ks, you can contribute more. Solo 401ks, you can contribute more, but we're just going to use an IRA example here. So over the 30-year period, applying a marginal tax rate of 25%, let's run our calculation here. In a taxable environment, we have, you'll see roughly $180,000 saved. Because see, every year in a taxable environment, as we generate profit, we have to pay taxes on that profit. With a self-directed traditional IRA or self-directed Roth IRA, we either defer the tax, or in the case of a Roth IRA, we completely eliminate the tax. So now we take that same calculation and we apply it to a traditional IRA, a tax-deferred IRA, meaning that when we take the money out eventually after 59.5, we have to pay taxes. You'll see there's $620,000 saved. So we have some significant savings there. You can see between tax-deferred traditional IRA and taxable account. Then we move into the Roth IRA, which a Roth IRA is funded with after-tax dollars. It grows tax-free. When we take the money out, we pay 0% tax. So as long as we follow the rules. You'll see here, we have $986,000 saved. So we have a significant savings between tax-deferred and Roth, and an even greater savings between taxable and Roth. So this compounding interest example gives you an idea of the power of an IRA and why we want to cherish those IRA dollars, because those IRA dollars create more tax-deferred or tax-free dollars. And then we leverage what we call compounding interest in the absence of taxation, which is one of the most powerful financial concepts that you can get to understand. So I hope you enjoyed this short explainer video on the financial crisis, and keep in mind what you can do about it. You don't have to rely on traditional money management. You don't have to rely on the traditional financial markets. You don't have to rely on just what you have in your retirement plan. So as long as you're eligible, you can make annual contributions. And we would encourage folks to do that. We encourage folks to not raid their IRA when times get tough, right? We want to do everything we possibly can do to survive without dipping into that IRA, because those are highly tax privileged dollars and they're protected monies. And you can self-direct into real estate, mortgage notes, trustees. You don't have to rely on the traditional financial markets to save for your retirement. You can take financial control. I hope you enjoyed this training video. Until the next program, keep leveraging compounding interest in the absence of taxation.